Okay, dear students, good day to everyone. Let's start a new topic. The name of the topic is cost of capital. Alhamdulillah, Summa Alhamdulillah, we have completed investment appraisal. Now we are starting a new topic. The name of the topic is cost of capital. Just a minute, cost of capital. Another name is weighted average cost of capital. Now listen. Relating to cost of capital, first you need to have a really good understanding of two things. Number one is, what do you mean by cost of capital? Actually, cost of capital represents cost of financing. What it does? Cost of capital represents cost of financing. So simply cost of capital means cost of financing. Definitely when an organization is going to make an investment, when an organization is going to make an investment in any project, so they need to raise finance from different sources of finance. Each source will have its own cost. There's nothing free in this world. You might have heard this many times. So cost of capital represents cost of financing. Next question. What is the objective of calculating cost of capital? Why do we need cost of capital? Why? The answer is, the objective of cost of capital is investment appraisal. If you don't want to, if you're not having any investment appraisal issue, you don't need to calculate, you don't need to find out cost of capital. So objective of cost of capital is investment appraisal. And you should know one thing, that investment appraisal, which we have just completed, investment appraisal is a long-term decision. Keep that thing in your mind. Why it is necessary to highlight over here that investment appraisal is a long-term decision, I'll tell you. Wait for that. So two things I have cleared. Number one, cost of capital represents cost of financing. Second, objective of cost of capital means investment appraisal. Okay, now, when we say cost of capital, let us see what are the sources of finance available to us to raise the finance. An organization can raise the finance in the form of equity. If an organization raises the finance in the form of equity, then the cost is KE, cost of equity. If an entity raises the finance in the form of debt, means loan, then the cost is KD, 1 minus T, that is cost of debt after tax. Why did I write cost of debt after tax? Let me tell you one thing. Whenever entity raises the finance in the form of debt, obviously they have to pay interest. Fixed payment of interest results in tax saving. That is why we have written KD1 minus T, cost of debt after tax. I have not written 1 minus T with KE because to the shareholders we provide dividend, and dividend is already after tax. So whenever entity raises the finance in the form of debt, the cost is KD1 minus T, that is cost of debt after tax. Third and last. If an entity raises the finance in the form of preference shares, if an organization raises the finance in the form of preference shares, then the cost is KP. That is cost of preference shares. So when an entity raises the finance in the form of preference shares, then the cost is KP, cost of preference shares. Okay. You might be thinking, sir, we have two types of preference shares, redeemable and irredeemable preference shares. I'll cover both of them. Don't worry at all, inshallah, but not now. Right now, let's discuss KE. How do we calculate KE? Cost of equity. For calculating KE in financial management, we have two mathematical relationships. When it comes to AFM, we have three mathematical relationships. But right now, obviously, we are studying FM, financial management. So let's talk about the two mathematical relationship. One is Capm. By using Capm, you can calculate KE. What is Capm? Capital Asset Pricing Model. Capm. Capital Asset Pricing Model. Another formula is Dividend Valuation Model. Or you can say Dividend Growth Model. Dividend Valuation Model. Dividend Growth Model. So in financial management, actually, we have two, you can say, formulae to calculate KE. One is CAPM, another is DVM. Now let us first discuss CAPM, Capital Asset Pricing Model. That by using CAPM, how do we calculate KE? Let me write the formula. KE is equal to RF plus RM minus RF, and then we have equity beta. Let's write KE. K is cost of equity. K is cost of equity. Now, try to understand one concept. The same thing which is cost for one entity, the same thing is written for someone else. Repeat. If the same thing is cost for one entity, definitely the same thing is going to be written for someone else. Example. If your organization is taking loan from the bank, so obviously your organization will have to pay interest, and that is interest expense for them. Bank, on the other end, is going to receive the interest. So obviously for a bank, it is an interest income. So expense for one party is income for another party, which means that cost of equity, it is a cost for the organization. Let us give another name to KE, that is minimum return required by the shareholders. Minimum return required by the shareholders. So it is cost for the entity, but for the shareholder, we say it is the minimum return required by the shareholders. Okay, RF. Risk-free rate of return. Risk-free rate of return. Now the question is, what do you mean by risk-free rate of return? Actually, risk-free rate of return means your entity has made an investment which does not have a risk. Now you might be thinking, sir, please tell us the name of that investment which does not have a risk. Unfortunately, we do not have any investment for which you can say that it is 100% risk-free. Okay. If we exactly don't say any, we cannot say any investment as XYZ. You cannot, pick even a single investment to which you can say it is 100% risk-free. It means that in financial management, then there should be a benchmark of risk-free investment. And then that benchmark should have a reason why it is a benchmark. Listen. In financial management, the benchmark of risk-free investment is investment in government bonds. If an entity makes investment in government bonds, it is treated as risk-free investment. So the benchmark in financial management, either it is basic financial management, which you people are studying, or advanced financial management. So actually in financial management, the benchmark of risk-free investment is the investment in government bonds. Now there's a question. Why do we have the benchmark of risk-free, that is investment in government bonds? There's a reason. The reason is normally, please listen the wordings nicely. Normally, governments do not collapse. Normally, governments do not collapse. That is why we are saying if your organization is investing in government bond, it is a risk-free investment. I said government, normally, it's not going to collapse. If somebody asks you the question, what happened in, let's say, there are a number of countries, what happened in Sri Lanka, what happened in, let's say, Spain, Portugal, and there's so many other countries. They went, they went bankrupt, I would say simply. So the question is, what happened to those governments? Actually, we saw the default in Sri Lanka. So what about investor? They invested in government bonds. So that is why I'm telling, I did give you the concept. The concept is I said normally governments do not collapse. That is why in financial management, the benchmark of risk-free investment is government bonds. Okay. RM. RM is the average return on a stock exchange. RM is average return on stock exchange. RM is the average return on a stock exchange. This will always be given to you in exam. RM minus RF. Okay, there should be a name for this. RM minus RF. The name is equity. Why did I write equity? If you are going to buy shares of any organization, you will become an equity holder. That is why I've written equity. Now risk. Why risk? Obviously, after making an investment in XYZ company shares, you will face the risk and the premium. Actually, premium means over and above something. When someone is making investment in XYZ companies, organizations shares, then they are expecting return higher than RF. Because if RF is 10%, it means without taking any risk, you can generate the return of 10%. Which means that making investment in a stock exchange, we actually won't return more than RF. So the difference between RM minus RF, the name is equity risk premium. Another name for the same thing is market risk premium. So you have to be very careful while reading the question, because sometimes what examiner does, instead of giving you RM, he gives you RM minus RF. Okay. Finally, in the formula, we have equity beta or beta equity, whatever you say. Or let's say beta equity, it's no issue at all. Now the question is, what do you mean by beta equity or equity beta? Before developing any understanding relating to equity beta, you just need to have a really good understanding of beta. Actually, when we say beta is a measure of risk. It's a measure of risk. When we say risk, logically in financial management, we talk about two risks relating to this beta. We say beta is a measure of risk. So there are two types of risk. One is systematic risk. Another is unsystematic risk. Repeat. There are two types of risk. One is systematic and another is unsystematic. Okay. Actually, unsystematic risk is a diversifiable risk. It is a diversifiable risk. Diversifiable risk means the risk which you can spread, you can reduce, even you can eliminate. Example, assuming if you have, let's say, $100,000, okay, if you invest the entire $100,000 in any one of the organizations, only in one company you have invested entire 100,000, it means the entire 100% investment is in one organization's shares, which means that if the share price of that organization increases, your 100% investment will increase. But the sad news is, the sad news is, if the share price reduces, your 100% investment value will reduce, because you did not spread your investment. You did not spread your risk. You have invested only in one organization shares. Now, instead of this, if you do one thing, if I take this 100,000 divided by 20, I'll get $5,000, which is 5% of my total investment. Now listen. Now, instead of investing entire $100,000 in one organization shares, if I invest $5,000 in 20 different organizations belonging to different industries, now what is the benefit? Now, if let's say out of those 20, even the one organization's share price reduces, so I'll be facing a loss at 5% of my investment. I'll be having a loss in 5% of my investment, but still there are 95% chances that I'll get a benefit. Even the share price of two organizations reduces, so it means you can say that on 10% of your investment you are facing loss, but still there are 90% chances you will have the benefit. So why it is happening? Because I did one thing, and this time I did not invest the entire $100,000 in one organization shares. I have invested in different 20 organization shares, and in every company I invested the same amount, which is $5,000, means which is 5% of my total investment. This is how you spread your unsystematic risk. Now listen and listen carefully. In capital asset pricing model, in Capm, we have an assumption. The assumption is the investor is having a well diversified portfolio of investment. That is why unsystematic risk is zero. Now, practically, even investor does not have a well diversified portfolio of investment, but still, we'll be solving the question according to this assumption. The assumption is investor is having a well diversified portfolio of investment. Investor means, for example, if you are investing in any one organization's shares, so you are the investor. We are saying investor is having a well diversified portfolio of investment, not the investee. Investee means where you are investing. So assumption relates to the investor. Now listen. Capital asset pricing model, Capm, assumes that investor is having a well diversified portfolio of investment. Therefore, unsystematic risk is zero. Now let's talk about systematic risk. Let's change the color as well. Systematic risk is not a diversifiable risk. This is not a diversifiable risk. This is the risk which your organization will have to face. For example, if the government increases the interest rate, that is one of the examples of systematic risk. You can't do that anything. If the government increases the interest rate, okay, obviously it will not have a good impact on your business. Example, if your product is very expensive and people need financing, people need loan to buy your product. If the interest rate increases, then obviously nobody is going to take loan. And the majority of the people, you can say, they will not take the loan to buy your product. Like it is happening nowadays in our country. basically the interest rate is so high that people are not going towards car financing. Because obviously nobody can pay such a high interest. So increase in interest rate, another example could be increase in tax rate. If your government increases the tax rate, you can't do anything. Devaluation of your currency, that is another example of systematic risk. So systematic risk is the risk which you cannot diversify, you have to face it. Let me give you another example of systematic risk sometime. Even the environmental problem, environmental issues, they play the role of systematic risk. Example. See, if we talk about developed countries, obviously USA, Canada, countries like that, and UK also, obviously, these are the examples of few countries, they are developed countries. There are so many others, obviously. But let me tell you one thing. In extreme winter, the country like US, to be very honest, in extreme winter in USA, the flight operations becomes very messy. Not the messy, the one who plays football. It becomes very messy. So they've lots of people, they get stuck in every winter on different airports. So look at this, such a developed country, but they can't do anything. They just keep reshuffling the schedule and people face all the problems. So it means the environmental issue is a systematic risk. So systematic risk is not a diversifiable risk. This is the risk which you have to face it. Now listen and listen carefully. In capital asset pricing model, actually, we have an assumption. The assumption is the investor is having a well-diversified portfolio of investment, which means that investor is not facing any unsystematic risk. But investor does face systematic risk, which means that so far we have not discussed anything regarding beta equity or equity beta, but one thing is for sure. Beta equity is a measure of risk and definitely it measures the systematic risk. Why? Because in capital asset pricing model, we have already made an assumption that we have the assumption. The assumption is a unsystematic risk is zero. Why it is zero? Because we assume that investor is having a well-diversified portfolio of investment. Now let's talk about beta equity. Beta equity is a measure of systematic risk. Is a measure of systematic risk. Which indicates that how your investment will respond to the changes in a stock index. How your investment will respond to the changes in a stock index. Okay. So beta equity is a measure of systematic risk of your investment, which gives you the information that how your investment will respond to the changes in a stock index. Now, let me just write a data, a very simple data, and in that very simple data, we'll be having two objectives. One, obviously, we'll be calculating KE, but the second objective is more important, that is interpretation of each result. Let's see. Change the color. RF, I'm taking 8%. RM is, let's say, 15%. Beta equity is 0. Beta equity is 0.75. Beta equity is 1. Beta equity is 1.5, and you need to calculate KE in all four situations. I really want every one of you pause the video, attempt the question, and then you can always unpause the video. So I hope you are watching the lecture after attempting this question. Number one. have a really good focus on interpretation. Beta equity zero means you have made a risk-free investment. If you made a risk-free investment, then you should demand the return which is equal to risk-free return. It means K should be equal to RF. Because you're not beta equity zero means the investment is risk-free. If the investment is risk-free, so the return should be equal to RF. And it is happening in the first question. RF percentage is 8. RM is 15 minus 8, the beta equity is 0. This 0 will make the entire thing 0. So K will be equal to 8%. So this is your first finding. When beta equity is 0, KE will be equal to RF. Second, in second case, your beta equity is 0.75. Now listen. When beta equity is less than 1, it means your investment is less riskier than the market. Repeat. When your beta equity is less than 1, the interpretation is your investment is less riskier than the market. Now listen, if your investment is less riskier than the market, K should be lower than RM. Obviously, when your investment is facing risk less than the market, then you should demand the return which is less than the market. It is happening in the second case. K is equal to RF, which is 8%, RM is 15 minus 8, and the beta equity is 0.75. Let's see what is K. So dear student, I'm getting 13.25%, which is lower than RM because RM is 15%. So this is case 2, finding 2. Let's go for 3. Beta equity is equal to 1. Beta equity is equal to 1 means it's a benchmark beta. Repeat. Beta equity is equal to 1 is a benchmark beta, which means that the systematic risk of your investment is equal to the systematic risk of the stock exchange, systematic risk of the stock index. Your investment is facing the same risk which is in the market. If my investment is facing the same risk which is in the market, then KE should be equal to RM. And you can see that it is happening in third one. Obviously, this will be cancelled out and K will be equal to 15%. Now, fourth and the last finding. If beta equity is more than 1, now listen and listen carefully. If your beta equity is more than 1, it means your investment is more riskier than the market. Market means I'm talking about, let's say, stock exchange. If your investment is more riskier than the market, then you should demand the return which is more than the market. K will be equal more than RM. Let's see. K is equal to RF. I think it is 1.5. Let's see. Yes. It is 1.5. Let's see. I'm getting 18.5%. So you can see that. Now, very important concept which I'm telling you. Listen and listen carefully. Extremely important concept. You have to listen very carefully. Okay? Concentrate. Please try to understand. When beta equity is equal to 0, K is equal to RF. When beta equity is less than 1, then your K is less than RM. When your beta equity is equal to 1, then K is equal to RM. When beta equity is more than 1, your K is more than RM. It means, what will be the K? What will be the cost of equity by using capital asset pricing model? It actually depends on the systematic risk of your investment. The higher the systematic risk of your investment, the higher will be the K. So if somebody asks you a question, what is the interpretation of K which you are getting from Capm? The interpretation of KE which we are getting from Capm, we can say that KE from Capm actually relates to systematic risk of investment. KE from capital asset pricing model relates to systematic risk of investment. KE from capital asset pricing model relates to systematic risk of investment. So this is all about capital asset pricing model, but we have already discussed in financial management to calculate KE. We have two formulae. One is capital asset pricing model, another is DVM. But I did mention, obviously right now we're not studying AFM. In AFM, actually we have three. But right in FM, financial management, we have only two. Now let's discuss DVM. Dividend valuation model. What is the formula of calculating KE by using DVM? KE is equal to D naught 1 plus G upon P naught plus G. Interpretation is same. KE is cost of equity. Another name is minimum return required by shareholders. Minimum return required by the shareholders. D naught is current dividend per share. G is the annual dividend growth rate, and in DVM we assume that annual dividend growth rate is constant. Annual dividend growth rate. Now listen. D naught 1 plus G is actually equal to D1, which means next year expected dividend. Now listen. If I give you D24, 1 plus G will give you D25. If you have been given D25, then 1 plus G will give you D26. Okay, now, what is P naught? P naught is the current share price. Which is X dividend. X dividend means excluding dividend. P naught is the current share price, which is X dividend. X dividend means excluding dividend. There's another share price also possible, which is cum div. Cum div means cumulative of dividend means including dividend. In dividend valuation model, we don't use cum div value, we use X div value. Now, let me ask you a question. The first question is, why do we use X div share price in this dividend valuation model? Why we are not using cum div? That's one question. Second, by using dividend valuation model, whatever the KE comes, will it be equal to the KE which we are getting from Capm? It can be equal, it cannot be equal. In what situation it will be equal, in what situation it will not be equal? Another question, what if the dividend growth rate is not given? How do we apply DVM? That's a good question. Now listen. If you really want to know, why do we use X dividend share price rather than cum div? If you really want to know that, are we going to get the same KE from DVM? In which situation? What is the situation in which we get DVM KE from DVM Capm same? And what is the situation in which we will not be getting the same K from both the formulae? And what if I have a really big question, and in that big question, let's say I have calculated KE from Capm as well as I have calculated KE from DVM. So which KE I'll be using to calculate cost of capital? If you really want to know the answers of all these questions, obviously you have to see my next lecture. If you're not enrolled, you should enroll yourself. And just few things. Number one, if I talk about financial management and financial management, the way back one of my students took 94 marks. So Alhamdulillah, Summa Alhamdulillah, I have produced, my college has produced at world top in financial management, world top in advanced financial management. We have produced number of position holders in SBR, ATX, PM, tax, FR. The number of papers which personally I'm teaching in my college, I do teach performance management, your taxation paper, FR paper, FM. I do teach ATX, SBR, AFM. And in my college, in Abeel School of Accountancy, you will get all the papers from FIA till P7. All the teachers that are expert in their fields, all have the experience more than 1 decade. Some of them are even having teaching experience of 2 decades, including myself. When it comes to my college, not a new college, there's Alhamdulillah, Abeel School of Accountancy was, I would say, came into action on 1st May 2009. So all the papers are available, each and everything is available. You can always contact AS admin. Let me write the number, that is 0092 if you're outside Pakistan. 333 666 214. That is ASA admin number. For the students, they are outside Pakistan. If you are within Pakistan, then your number is. So you can contact us on YouTube, Facebook, LinkedIn, Instagram, on all the social medias, I would say. We are there, Alhamdulillah. So we are here to help you. And I always, let me tell you one thing, I always teach from zero. I always assume a student that don't carry any previous knowledge, and I'll try my best to make the lecture interesting, relevant, and important thing is short. I am the one who's, I would say, I'm fond of short lectures, because to me, if the lecture goes to, even the lecture exceeds 1 hour, student, they lose their interest. Majority, I would say majority or almost all of my lectures, you will see that the range of my lecture is from 40 to 45 minutes, not very long. Because the lecture, the longer the lecture is, student will not have the interest. They will pause the video half-heartedly. They will be sitting in front of the screen, and in one go, they are not, majority will not take 1.5 hour to 2 hours. So, and in my course, I cover each and everything. Each and everything means each and everything. Most of the time, you just need to do one thing, just watch all my lectures. That is good enough to pass the paper. So thank you very much, and see you all in my different courses as well as in FM. Thank you very much. Thanks a lot. Have a nice life.